bounce, baby, make it bounce. Work that back, baby, act bad. Yeah.
Sharp as always.
Thank you, sir. Very kind of you, man.
So how does traditional private equity make money?
How does traditional PE funds make money?
Yeah.
One, they go on a roadshow and they convince larger investors, whether that's universities, pension funds, endowments, to commit money to their fund. The fund typically has a mandate, which is to say we're going to go and buy businesses in a certain sector, and they get a fee for the total assets that are being managed, which is called the assets under management, the AUM. Traditionally, that fee has been 2% of the total assets under management. So if they have $1 billion in capital commitments, they charge $20 million per year. That's the first way they make their money. That's what they use to pay their offices, their staff, their labor force, access to software, as well as that's how the partners themselves derive a living, a very good living. Now, the second way that they make their money is the performance of those assets that are being managed. So typically, the second way they make their money comes later down the line based on future performance. And there they get what's called a carried interest, which is essentially a piece of the upside above and beyond minimum performance thresholds. And traditionally, that was 20% of upside. Now, one last thing I'll mention is there's something called a hurdle rate. It's called a hurdle rate. It's a bit loud. Get a sip of my coffee before it gets too damn cold, right? I always thought it was fancy when they put the coffee in these like little Italian cups.
Yeah, the smaller the cup.
The smaller the cup, the fancier the coffee. Hurdle rate. So a hurdle rate is essentially the minimum performance threshold that the traditional private equity fund manager has to achieve, above and beyond which point they get to unlock their carried interest, right? Which is their 20% of performance. And the reason there's a hurdle rate is, think about it from the investor's point of view, the one putting money into the fund. They could take their money, they could put it in United States Treasury bonds, very safe, very low returns, but very safe. They could take their money, they could put it in the S&P 500, which is typically the 500 largest companies in the United States. Historically, that does between 6 and 8% annualized returns. So these are safe bets. So they could safely get between 6 and 8% by betting in an ETF, which is an exchange-traded fund. It's just an instrument of getting, through one investment, access to multiple stocks. They could do that and get 8% a year. So why should they pay you on the first 8% where they could get that without risk? Which is why there's a hurdle rate that typically means above and beyond the minimum performance threshold. Only at that point does the fund manager start to unlock carried interest. So that's how they make their money, two ways. Fees from assets under management, carried interest above and beyond a certain hurdle rate. Does that make sense?
Is that hurdle rate like 8% then?
All of this stuff is negotiable. So these are the levers. These are the levers of discussion and levers of negotiation. But I would say it also depends on the track record of the fund manager, because we say fund manager, but some of these are literally global institutions that have been trading for 50 years. Some of them are on their 15th fund, 16th fund. And so there's a lot of demand for access to their product, versus you might have a first-time money manager who's maybe 45 years old, who used to work at one of these institutions, but who's never launched a fund before, and they may have a different hurdle rate because the investor is taking a larger risk, a bet on this manager. But I would say, generally speaking, 10 to 12% hurdle rate is what a new manager should expect. By the way, this is a compounded hurdle rate, right? So what that means is, imagine that the investors commit to $1 billion, and it's a 10-year life cycle. And imagine that they say it's a 6-year investment cycle and then a 4-year maturity cycle, right, where they make divestments or IPOs. and maybe with the possibility to extend for 2 more years so that it can be 12-year total cycle, of which 6 is investing and the second 6 is reaping the returns. There's not going to be a return every business every year, right? It might take many years to build a group and then list it on a stock exchange, for example, or to build a group and then exit, for example. And so this hurdle rate of, call it 10 to 12% per year, is a compounding hurdle rate. Does that make sense? Meaning, if exits only start happening by year 7, then the manager has to deliver, first and foremost, a 10 to 12% annually compounded return to the investor, beyond which point they can then unlock their carried interest, which traditionally could be 20%. But in the meantime, they're extracting management fees, which is simply a percentage of the total assets under management. Traditionally, that's been 2%. Now, in reality, 2 and 20 is dead. 2% management fee, 20% carried interest. That's sort of the vanilla of private equity. But that 20 years ago, 30 years ago, but now that's kind of dead. I think more realistically now, what you're seeing is anything from like 1.5, for example, maybe 1 to 1.5% annual management fees, to maybe 10, 15, sometimes 20, sometimes 30% carried interest. It really depends. This idea that there's 2 and 20 fixed is dead. I think it's negotiable every single time. Negotiable per fund, negotiable per investor, negotiable per investment cycle, right? Depends. Any business, whether you open a restaurant, a barber shop, or whether you open start a tech company, you have a ramp-up period where you're not making any money. Assuming at some point you do start making money, what are the levers that you can pull on to make some money? So what I would say is, first and foremost, we talked about in other episodes that you have employment, you have ownership, and you have control. And when you're a deal sponsor and you buy a business, you can essentially be employed by that business. Employed as what, you might ask? You can be employed as the group CEO. I wouldn't advise it, but you could be. You could be employed as the chairman, the chairperson. That's possible. But these are titles and designations. The function is essentially you can be a director. So especially in the UK, this classification of being a director comes with certain duties. Typically in business and commerce, duties that you have to adhere to are referred to as fiduciary duties. And as a director in a UK business, by accepting that role, you also accept certain fiduciary duties. Now, what are those fiduciary duties? Those duties are that you should act in the best interest of all shareholders. So as a director in a business in the UK, you literally have a legal mandate to act in the interest of all shareholders. Interestingly enough, if you unfortunately end up in an insolvency situation where a business is going under, your duties then shift from having a fiduciary duty to shareholders to then having a fiduciary duty to creditors. But that aside, you absorb these duties. Now, as a part of taking on some of these duties and being the deal sponsor, the one that put it together, the one who is sort of managing communications and interactions between the previous seller, who's probably now a consultant of some sort, the investors who put in the equity, and the banks, being the chief liaison between these people and being the one managing or at least overseeing the daily management teams, whether it's the MDs or the CEOs, you can, in exchange for those services, extract a service fee or extract a wage or extract a salary. And obviously your ability to extract that service fee, that wage, that salary is sort of influenced by the size, scale, and profitability of the specific business. In other words, if you buy one company and it's a tiny business, doesn't make a lot of profits, your ability to extract fees is limited. If you buy a few businesses that do make profits amongst themselves, your ability to extract a wage, a fee, is increased. So that's one way. The second way, which you never really get to, is eventually at some point you are a shareholder, and at some point you're a shareholder in a business that is presumably debt-free, right? It is unencumbered of credit obligations. Why? Because it's gone through its amortization schedule, right? So it's paid down its debt over 3, 4, 5 years, and having been fully amortized, paid all of its debt down, now you are a shareholder in a profitable business that, net of paying taxes, typically has net profits. which can either be kept in the business, which is called retained earnings, because you want to keep it there because you want a liquidity cushion for future commercial shocks, or maybe you want a little bit of working capital to go do other things within the business, expand through hiring people, or you sort of extract some of that working capital by paying a dividend. If you keep net profits, it's called retained earnings. If you pay them out, they're typically paid out as what's called dividends. And being a shareholder in a business that's now free of debt, it's no longer encumbered by creditors, you participate as a shareholder, what's called pro rata. Pro rata, Prorata. All that means is if you own 10% of the business, you get 10% of the dividends. If you own 35% of the business, you get 35% of the dividends. So that's another way that you can make some money. I have not extracted any damn dividends. That shit is hard. Why? Because the point is, if you keep buying businesses, you keep pushing the reset button on credit. So you buy a business. It's got a 4 or 5 year amortization schedule. If you wait 6 years, it's debt free. It starts paying dividends. But if year 2 you buy another business, you just push reset. Year 4 you buy another business, you just push reset. What do you think I keep doing?
So if you do a pure equity deal, like buying a business entirely with an investor's money, can you even keep any ownership for yourself?
Yes. I don't think of things in binary ways. So I like to think of things of what is the universe of optionality. So when you're negotiating with investors, what are the sentiments that are involved? What are they trying to optimize for versus what are you trying to optimize for? The equity investor is trying to optimize for a return on their investment. We got a guy in the back playing with a guitar, so hopefully the sound is acceptable. But the equity investor is trying to optimize for a return on their investment. Ideally, they probably don't want to have too much of their bandwidth allocated to this investment because they typically have a wide portfolio of other investments, meaning they don't want to show up on Monday morning and turn the lights on. They want someone else to do it. Ideally, they want to have a dedicated team in place that makes sure that the business performs against budget and against expectations such that they don't suffer permanent loss of capital. And in order to do that, they need to incentivize other people. Who are these people? Well, the managing directors that run the daily operations through a salaried compensation as an employee, typically a group CEO, assuming you're building a group, who maybe has a salaried compensation as well as some equity participation if it works out. But at the end of the day, you, as the deal flow debt equity guy, watching 0 to 100 million, looking for companies to buy, you, the alternative private equity guy, are the deal sponsor. You're the one who put it together. You're the one who found the company, negotiated the terms, got the seller on board, managed the seller expectations, lined up the credit, right? Speaks and liaises with the banks. Probably the one that identified the CEO, put that manager in place. And you're the one who is the ultimate steward of responsibility for the entire investment as a package. Therefore, you need to be incentivized. Your primary means of incentivization is unlikely to be a salary in a deal that you put together yourself. It's likely to be some sort of share participation in the business. So my answer to you, when you ask if you fund a deal through just pure equity, can you even keep shares, is to say the instrument of finance has nothing to do with the terms of the investment. Whether or not it's 100% equity funded or some combination of bank funding and equity from an investor, all that represents is the capitalization of that investment. At the end of the day, there's a capitalized investment, and then there are the people that manage that investment. In many ways, you are the replacement to the traditional fund manager that has assets under management. Keyword, under management. Someone is staying up at night making sure that those businesses are performing and is preempting the potential issues and challenges around the corner and presumably mitigating those issues, therefore mitigating the risks that are associated with those issues so that the investor can sleep at night, having a diversified portfolio that now includes this investment. So that's a long answer. It's a long way to say, I do not foresee any scenario where it is acceptable that you, as the alternative private equity guy, the deal sponsor that puts this whole thing together, doesn't get shares. Why? Why would you even accept those terms? I mean, presumably once you have got the deal under letter of intent, you have control, command and control of that transaction. So if the proposed equity investor fails to see that you are more valuable being a shareholder, take that deal somewhere else. It's like going to a public basketball court, but it's your fucking basketball, dude. So if I don't get to play, no one gets to play. Walk off the court with your basketball. And in the meantime, you know what to do. But 0 to 100. I'm out. I got meetings back to back. I don't even know what the fuck I'm doing here so long with Oscar. Holla at you later, boy.
Yeah, see you.